Beautiful. Ray, how are you doing today, my friend?
Doing great, Kirk. Thank you so much for inviting me to join you on this webinar.
No, it is an absolute pleasure to have you. We've been looking forward to speaking with you for quite some time now. We know you are a metrics master and you've got all the industry benchmarks to prove it. And so we'll wait here for maybe one more minute as people joining, maybe meetings are going over, maybe they're grabbing their lunch, whatever the case may be. But high level, thanks for coming. Where are you today? Which state of the
I'm
world
in
are you
I'm
in?
in I'm in New York City. I hop around quite a bit between New York City, San Francisco, Southern California, Los Angeles, and weekend house in Pennsylvania. So I'm never in one place more than about 3 days, Kirk.
Sounds like the true consulting lifestyle, but you're not in consulting.
Exactly.
Good stuff. Well, I too am in New York. Hello to everybody joining from around the state and around the world. We normally have a pretty global audience today. If you'd like to chuck in the chat where you are, feel free. If not, no problem. Today, we're obviously talking about usage-based based pricing models. And we're here with Ray. If you have ever joined our webinars before, you know that I'm Kirk, the Director of Strategic Finance here at Drivetrain. I have the privilege of interviewing great minds like Ray. You've also might have seen me in some of our demos or online tools, or talking about the different features that we're going to be releasing. Ray, I'd love if you could give everybody an overview about who you are, who's BenchmarkIt, and what's your guys' sort of mission in the SaaS world or metrics world today.
Yeah. Happy to do that, Kirk. And whenever I join a webinar, it's like, why am I willing to invest 45 minutes, 60 minutes of my time to listen to someone? So what most people don't know about me is my first 10 years out of undergrad, I worked at the world's largest provider of hosted applications on a mainframe accessible via a global private network. And our pricing model was usage-based. So I did this for the first 10 years of my career. So, and this was now in the 1990s. So I have a long history here. Grew up in a usage-based pricing model. And over the last 25 years, been involved in multiple VC-backed software subscription model companies, 5 exits, 2 strategic, 2 private equity, and 1 IPO. And then about 3 years ago, I sat down on this mission to build the B2B SaaS and cloud industry's largest and most contextualized benchmarking database. And over the last 3.5 years, we've collected performance metrics data from 18,000 unique B2B SaaS companies across 22 different metrics categories with over 1 million unique data points, making up over 500 different benchmarks. So that's what I do.
So in other words, we can trust the data. Sounds like it's pretty well seasoned.
Yeah, there's a lot of data there, but as you know, you can tell any story you want. I just give the objective, here's what the data says, and you interpret it for yourself.
Love to hear it. Well, let's take a look at what we'll be interpreting today in terms of an agenda. So we're going to go through high level 4 items. We're going to take a look at the current state of usage-based pricing, see how calculating SaaS metrics with usage-based pricing can be done, and then how that turns into forecasting. Right. We'll have a bit of time at the end for Q&A. There's a variety of things in here, and I'm really excited to let Ray present a couple of these findings that he has. And then we'll have a little bit more discussion in 2 and 3 before 4 comes, and you guys have the floor in terms of questions for Ray or I. So let's jump into this really quickly. We're going to start off with a poll. How many of you today are currently using usage-based pricing? You can just respond right there. Once you do, that'll disappear. And then we'll be ready to move on. While they're doing that, perhaps, Ray, you can take a look at this slide and give us a little overview of the state of usage-based pricing today and some of these leading companies we see on the screen.
Yeah, and we're going to talk about our latest research with what percentage of B2B SaaS and cloud companies are using usage-based pricing, but it's not that new of a concept. In fact, back 2 or 3 years ago, pre what I call the SaaSacre, when enterprise valuation of SaaS companies went down dramatically since the second half of 22, companies like Snowflake and Datadog, they were talking about 150, 60% NRR. And that was the case because of their usage-based pricing models. And I always like to segment this. And by the way, so does OpenView and Kyle Poyer, who is one of the best thought leaders on usage-based pricing, into infrastructure, middleware, applications, and then vertical apps and vertical marketplaces. So it's very common. But let's get into the data, and we're going to show the benchmarking research about what percentage of B2B SaaS companies are actually using some level of usage-based pricing. So on the left-hand side with the green bars, this was research we conducted about 12 months ago, so it is 12 months old. Are you using any consumption or usage-based pricing attributes? 52% of companies said yes, they were using some type of usage-based, not user-based. 21% said no, and 12% said they were planning on introducing some level of usage-based pricing in the next 12 months. On the right-hand side, almost at the same time, was the OpenView benchmarks. And you can see where in 2022, it was 46%, so pretty close to our 52%. And then last year, there was a slight retreat. Now, there's always selection bias in any type of benchmarking, so it wasn't exactly the same companies. So on a directional basis, you can see that about 50 to 60% of companies are using or plan on using some type of usage-based pricing. But
good.
What's interesting is,
oh, sorry,
go ahead,
sorry about that.
Kirk.
I was just going to say that in our poll, we've just come back, and it looks like 43% said they're either implemented or plan to implement, 34%, and then only 23% said no. So I would say that the data here matches up pretty decently with what we're showing on the screen as well.
Yeah, and the populations of both of these were over 500 companies, so it wasn't a small, like a lot of times you'll see VCs say, here's the benchmarks in my portfolio, but it's an N of 40 or N of 50. These are Ns of 400, 500, 600 companies. So, well, let's look at the components, Kirk. So this is another question we ask before we get into what usage-based variables are being used. What's your primary pricing model, right? So what you see here is that 22% had just a pure subscription flat fee, not based upon any lever or value lever such as users or usage. 30% was still primarily using a user-based, the old seat-based pricing. 18% had a minimum commitment, a subscription that included X number of usage variables, right? We can think about HubSpot and their marketing platform for that, right? They have a number of contacts as their primary usage based. And then you had a hybrid model. And by the way, you could say, well, HubSpot's really hybrid, Ray, because they, in their entry level, say you can have 3 users and 1,000 contacts, right? But then there's the X of emails. So that would be kind of a hybrid model. But only 1% in our research had purely usage only, no subscription, no minimal fees. And all the research I've reviewed over the last 12 to 18 months, it ranges between 1% and 2%. So very few B2B SaaS companies are going 100% usage-based, no subscription.
And so, Ray, I know you're not meant to have opinions on these sorts of things because we're only looking at the numbers, but would you say strategically for most companies will expect to see more, that 1% increase in? Or would you say that it's about where it should be in today's sort of technological age?
Well, I'm going to give a lot of data today, Kirk. So some other recent benchmarking research showed for companies under $1 million, about 60% were using usage-based as their primary. Wow. And they were growing about twice as fast as pure subscription user-based companies, right? Wow. And a majority of them were using no minimum commitment. They wanted to reduce their friction during this cautious capital environment and just say, pay as you use it, pay as you go. That's a great way in the early days, Kirk, to accelerate customer acquisition velocity as measured by logos. However, as you start getting into the predictability of your forecast and investors want to know, what are you going to be doing next quarter? What are you going to be doing for the next 12 months? You're going to see the same thing that happened to companies like Slack, Twilio, et cetera. They're going to quickly get those enterprise salespeople and say, go get a minimum commitment. And in return, give them a per unit cost reduction. But I want that $100,000, $500,000 commitment. So nothing's going to change. History repeats itself. Early days, less friction, less commitments. As you scale, more commitments, lower unit economic cost.
Makes sense.
Now, this was surprising. So we talk about, and we do a lot of work with companies when they're introducing new pricing models, mostly around how it impacts metrics and how they report those metrics. But you want to keep it simple. When you first introduced new pricing, you want to keep it simple. And by the way, it's better to introduce it to a new customer segment to just go back and try to retrofit existing customers. So that's one big piece of practical advice. When you start testing and experimenting with usage-based pricing, do it on a new customer segment, not on the existing. One usage variable is most common, 35%. This might be in some AI companies right now. It might be the number of prompts or the number of transactions. Two usage variables, and you could say, I use HubSpot because it's such a common one, right? Two usage variables. I got number of contacts and number of users, right? There's two things there. Now you can say, yeah, but there's add-ons like number of APIs or number of emails sent. So that could get into 3 or 3+ usage variables. But the most common and the safest way to start your usage-based pricing model is a single value pricing variable.
And so on this, Ray, would you say there's one that you've seen that is most common in the SaaS world? Is it maybe API calls, number of seats, whatever the case may be? Is there some one that sticks out above the rest in terms of ranking, order of operations?
Kirk, it's almost like you looked at my slides. Why don't we move forward, right? And so it all depends on the category that the software serves, like middleware, infrastructure, application, transactions. Now, loosely defined, but a lot of infrastructure where you're doing a lot of transaction movement. You could even say Twilio. Is it a message or is it a transaction? But a transaction was number one, 32%. Messages, even like an email message or a text, was at 8%. For your middleware API solutions, it was API calls. Database size was pretty low. It was only 5% of the participants in our research, about 500, said it was database, and then record count. Now, we position record count because based upon the category you're in, that might be contact count in the marketing automation space. It may be document count in content management, et cetera, but it's some type of number of records. So transactional and message-oriented systems were the early adopters of usage-based pricing, Kirk.
Makes sense.
Now, one of the biggest decisions companies have to make, and by the way, we invite questions. If you're going through this, if you've got a different experience, if you're thinking about A versus B, please throw those questions in the chat or Q&A. We'd love to take them, during the webinar itself. But one of the considerations is I just am introducing usage-based pricing. Do I cap it? And if I do cap it, what type of cap? So some people will put a hard cap. Okay, it's 1,000 messages, and you can't do 1,001 until you upgrade to the next level. That's a small percentage, only 5% have that. The second, especially for new customers and new usage-based pricing model introductions, it's a soft cap. Okay, yeah, it's 1,000, but for the first quarter or the first year, we're going to let you go over that and not charge you for overage. Now, that's not very common. It's 21%. I'm going to go all the way to the bottom one. That's where there's no cap, but we're going to charge you for every overage transaction or message or record, et cetera, during the term of that agreement. So let's say it's a annual agreement. There's no cap. You projected 1,000. We gave you pricing for 1,000. You do 10,000. That 9,000 overage will be charged. And then there's a consideration on the right-hand side. How often do you charge for that overage? You'll see that the most common is monthly. Hey, you had 1,000 transactions. You hit 10,000 this month. We're going to charge you for those 9,000 this month. 9% do that true up quarterly, and 10% do it annually. So most companies, because they're looking at cash flow, right? They're going to be doing that overage charge on a monthly basis, Kirk.
So how does someone go about determining a cap? Is there like a good rule of thumb for a company that's operating in, it could be any space? Is there a rule of thumb where you'd say, okay, it's this much plus that, it's a multiple of this? Is there a way, Ray, or is it truly up to the business to decide strategically what works best for them?
In the pricing that you put on your pricing page, right? Because if you're doing product-led growth and or usage-based pricing, highly recommend you put your pricing on the pricing page. That's becoming the de facto standard for usage-based pricing companies. It all depends on the category you're in, Kirk, right? So an example would be, oh, I'm in marketing automation and I go after the SMB, the mid-market, and the enterprise, right? Well, you might say I have my basic package or my starter package, knowing this is for the SMB customer. They're typically going to have somewhere between, let's say it's contacts, right? A minimum of 1,000, a maximum of 10,000 contacts, and they're going to have 1 to 2 users, right? So they often do it based upon the target customer segment that they're on. But there's no best practice, because if you look at Twilio, right, and they have multiple different products with different ones, they just basically say, okay, what's the minimum that we want to get from the initial customer acquisition, right? Okay, so we want to get at least $1,000 a month. So how many variable transactions do you get for that? So it also is based upon what your own internal economics are and what you want to see as that minimum revenue per month, per quarter, per year.
Gotcha.
Now, first big lesson in usage-based pricing is, 3 to 4 years ago, I talked about Snowflake and Datadog and Twilio. NRRs of 140, 150%, growth rates of 70, 80, 90%. So during the good times, when the economy is growing or your target customers are growing, or your customers are high growth companies, think about the customers who sold to Uber 10 years ago, and they sold on a transaction basis, right? They're like, Uber grows 300%, we're growing 300%, right? Because every message is using us. So during the good times, usage-based pricing will grow quicker. And I'm going to show you an example of that across 1,500 companies next. But at the same time, when markets start to have some headwinds, like we've seen in the last 2 years in the cloud industry, the market correction velocity and slope of that decreasing curve is much faster in usage-based, because it's easy to govern and throttle down my usage. Unlike a subscription model, I signed up for 100 users and it's still got 9 months left on that contract, right? So in that middle, you'll see that green line, which is subscription growth, kind of maintains while usage-based goes down. But as soon as the economy or the industry that you're serving or the customer base that you're serving starts to accelerate, usage-based pricing starts to grow much faster again. And if we go to the next slide, you actually see this. This is a report from Maxio Growth Institute around 1,500 companies that leverage your software for subscription billing. And the blue line was the usage-based or consumption-based pricing companies. Look what happened starting in Q1 of 22. They were at a 35% growth rate in Q1, Q2 down to 31%, Q3 down to 25%, Q4 of 22 down to 20% growth, down to 19%, and Q1 23. So you see the decrease of the growth rate was much faster. But look at the subscription on the green line. We had some decrease in Q3, but we kind of went back up in Q4. It wasn't until Q1 of 23. Why? A lot of customers bought in Q4 of a year, so they didn't renew, right? So that really impacted the growth rate. So then you saw subscription-based companies have lower growth rates. We're now in the last 2 quarters, I almost call this my canary in the coal mine. Usage-based pricing companies are growing faster again. They were at 22% in Q3 of 23, but in Q4 they started to grow. In Q1 of 24, they grew even faster. So usage-based pricing is great during the positive economic times and more challenging during the difficult times. I'll give you an example. Think about Zoom Info. Zoom Info, their largest customer segment was early stage B2B technology companies, right? Now they were subscription based, but they also were a number of contacts you were using, right? Their growth fell off the cliff for two reasons. Number one, the industry segment, which was 40% of their revenue, stopped buying, right? Other B2B tech companies said, we're going to stop buying all this stuff. And at the same time, they didn't have another industry segment that represented more than 6 to 8% of their business. So you got to be really careful about external macroeconomic variables that impact your growth.
Well, that's super insightful, right? I've also heard you say that, this is one of the best leading indicators for the economy, the fact that usage-based pricing can decrease so aggressively, almost anticipating what might happen to the rest of the world. And then when it increases, right, we can expect that these good times are coming.
Yeah, I'll go back to something as simple in B2C, because B2B software companies today, when I say software, I'm talking about cloud and SaaS, right? We're taking a lot of lessons from B2C companies. I mean, think about usage-based pricing. I mean, I'm a little older than some of the people on here. I remember when I paid for long distance calls on a per minute basis, right? That was usage-based pricing. So right now, if you did usage-based pricing and you were selling middleware to mortgage companies, you're going like this because mortgage refinance went up about 35% just in the last 2 weeks. So if you're doing that on a transaction or a new mortgage initiation, you're really happy right now, but you weren't happy 6 months ago.
So let's take a change of pace here. Let's take a look at the impact on the metrics. We all know that there's various SaaS metrics, everything from something as common as ARR to CAC, LTV, these sorts of things. But when we're taking a look at usage-based, it might not be the traditional, subscription multiplied by number of users. Let's take a look at the impact on these, right? I'd be super interested in your thoughts at a high level on ARR, new ARR versus expansion, these sorts of concepts from a UBP level.
Yeah. And the reason this one is so important to me, Kirk, is one of the good fortunes I've had over the last couple of years is I'm the co-founder of the SaaS Metrics Standards Board, along with other great thought leaders like David Spitz, who started the KeyBank Capital Markets Research, Todd Gartner, who launched the first credit-based revenue facility for recurring revenue at SaaS Capital, Ben Murray, the SaaS CFO. And we had to deal with not only the standard definitions and formulas for calculating SaaS metrics in the traditional subscription world, we had to start wrangling with how consumption-based pricing and usage was going to impact SaaS metrics. So some of the questions that we went over: ARR, annual recurring revenue. Is that variable revenue from usage-based pricing? Is that just GAAP revenue? We recognize it as it happens. Or is it ARR? Is it truly annual recurring? And then some fancy people out there in the digital ecosphere said, well, that's reoccurring, not recurring. It's like, what in the hell is the difference between reoccurring and recurring? But one of the standard best practices we recommend starts at your chart of accounts. You should have, yes, your subscription-based revenue, which is the firm subscription. And then we recommend a separate line item in your revenue, which is variable revenue. And variable revenue on your income statement is going to show that usage-based pricing. And hey, it was 3 million this quarter, but next quarter it's 3.8, and the following quarter we went down to 3.4. So number one, we truly recommend you have usage-based pricing driven revenue as a separate chart of account line item. And then you need to make a decision on, do you include usage-based revenue in your MRR and thus ARR calculations? The latest research says, and this was from about 4 months ago, 72% of companies using usage-based will convert that monthly revenue into ARR. 72%. Now, honestly, I think that's very dangerous. So our recommendation to all our clients are, you should show your ARR firm subscription commitments only, and then your ARR plus variable ARR, and show the two. So that way your investors are aware, oh, so you have 22 million of firm committed ARR and another 28 million that's variable that could or could not go down next quarter and the subsequent quarters. So that's what we recommend on ARR. And we're going to go into some of these in more detail, Kirk. New ARR versus expansion. Historic wisdom said, you should, if you're a recurring revenue technology company, 70% of your growth should come from new logo ARR, and 30% should come from existing customer expansion. But it starts with, how do I define when new logo ARR ends, and when does existing customer expansion ARR begin? Now, in the old world, well, we did a 1-year annual subscription as their first contract. We knew that was new revenue, right? Some people also called it a booking, but most people put that into new ARR. And then on month 13, if I had an increase, then that was my new ARR. I'm sorry, my expansion ARR, which is how you calculate net revenue retention, your gross revenue retention plus expansion. But you got to really define in your usage-based environment what is new and what is expansion. And I'm going to show a chart on that next. Same with gross revenue retention. What is my starting point for my ARR in that existing customer cohort this period? Then how do I calculate that in 12 months? What's the ending point? Because gross revenue retention, if you include variable-based usage in your ARR and the usage goes down, that could take you from an 85% GRR down to 72%, right? Well, no. I didn't really have churn. I really just didn't have as much usage. So there's no right answer here, Kirk, but these are the things that you need to think about and how usage-based pricing models are going to impact your SaaS metrics. Same with net revenue retention, right? You start with how you defining GRR, then you got to define what is ramp revenue versus expansion. By the way, let's go to the next slide because I think it's really important, if it's okay, Kirk, to really think about this in a, what's my business model? How long does it take a new customer to ramp on my usage-based priced product? Almost all companies are going to have a ramp up. Right? Maybe it's like, okay, well, let's say it's API driven. Okay, in the first month, we're going to do 1 or 2 integrations. And then once we prove the product works, the transactions are flowing, then we might go to integration point 3, 4, and 5. So what every company should do is define what your ramp up period is. Some, it may be 1 month. Some, it may be 3 months. Some, it might be 6 or 12 months, right? So that's going to be your ramp up period. And that's not expansion revenue. That is just your new customer revenue ramping up. And then once you've defined on average, what is my ramp up period, then everything from that point forward, let's say it's 6 months, from month 7 on, that's going to be considered expansion ARR. Now, as you can see from my description here, Kirk, one model does not fit all because it's based upon your product, your customer base, etc. So what we recommend is ramp up growth as part of your new ARR. Once you define my ramp period is over, then you're going to determine what your expansion ARR timeframe and the associated revenue. And now you've got to think about, well, now that I define ramp versus expansion, how does that impact my metrics calculations? Of course, net revenue retention is an easy one, right? Because that's going to be looking at all your expansion from that customer cohort. So if you start expansion earlier, your NRR might look better. CAC. Well, CAC, in things like CAC payback period and CAC ratio, you're typically looking at how much new ARR did I bring in, and you divide that into sales and marketing expenses, CAC payback period on a gross margin adjusted basis. So now it's like, well, wait a minute. If I have no commitment or a low commitment, and I know that customers ramp over 6 months, how do you determine what your customer acquisition cost ratio is? Because you don't know exactly what the committed ARR is, right? So all of your CAC efficiency metrics need to be defined for a usage-based pricing model. Now, I could come and say, well, that should be your first 12 months, right? That should be the value of the contracts, right? To make it easy. But some companies may say, no, it's the first 3 months, it's the next 6 months, it's the next 12 months. So you got to define it for yourself. Was that clear enough, Kirk?
That was great. I can very clearly see how they're all interwoven and how each company needs to define for itself what that ramp period is, where at this point now, this is the ramp and here's the expansion. It allows for some sort of measurability. And if you're not measuring it, then what insights can you really pull from it? I've
Now,
just got a
here's what I've
question
seen.
here. Oh, go ahead.
Go ahead, Kirk.
I just received a question here, Ray, from Chris. How do you think about usage-based variable pricing versus traditional SaaS fixed license pricing in terms of corporate value? Does one receive a higher multiple than other in an exit? I can see where you have the ability to grow revenue faster in those good periods with UBP, but does an acquiring company place more value on guaranteed revenue streams?
Well, the best way to evaluate and analyze that is look at publicly traded SaaS companies, right? And if you go back and even look at the last 12 months, the highest correlation or cause and effect to enterprise value to revenue models or multiples is still growth.
Sure.
So whatever model drives the highest growth rate is number one. Number two is some minimal level of profitability. So I don't want to derail us here, but rule of 40, right? That's what it is. It's your growth rate plus your free cash flow margin. And if you look at the new rule of VAX by Bessemer, and Meritech Capital does a lot of great research on this also, growth has a 2.3 times higher impact on enterprise value to revenue multiples than profitability, free cash flow margin.
Wow.
Now, if you look at this in a kind of a matrix manner, the companies with a 27% and above growth and a 10 to 20% free cash flow margin have the highest multiples. So I answered your question with, it's not pricing model, it's the pricing model's effect on your growth rate, your profitability, and then third, NRR. NRR is still the number 3 causal factor in enterprise value to revenue models. Did I answer your question okay?
Yeah, I think you'll have to ask Chris, but I think Chris would be super pleased with that. Let's jump on here. Anything else on this slide, Ray, before we jump on to the next?
Yeah. So if you're doing usage-based pricing, you have kind of a hyper land and expand. Hey, I want some type of minimal commitment skin in the game. Let's say it's 10,000, but I know for a customer in this industry or this segment, they're going to be doing 100,000 in 12 months, right? An option for your metrics is you can say, okay, I'm going to do things like CAC payback period on the forecasted revenue or ARR for those accounts in that category. Hey, they're in the automotive industry. I know this is their company profile, so they're going to do 100,000 in the next 12 months. So you can do your efficiency metrics on the forecasted, I'm going to call it annual projected revenue. We'll talk about in a minute. And then after 12 months, redo those calculations on the actual GAAP revenue. And it really holds you as an executive leadership team accountable for your forecasting in a usage-based pricing model. Yeah, I said my CAC payback period was projected to be 23 months. And now when I do a 12-month look back, it was 21 months. Better. It was 28 months worse. So I strongly recommend you do both a booking/forecast model and an actual GAAP revenue model. Now, the other thing is on your CAC efficiency metrics, right, you should really look at it by customer segment, because that way you can say, yeah, well, my cost to acquire a enterprise customer was this, I know that, but the projected revenue in this usage-based pricing model is going to be 100,000 versus my cost to acquire a SMB customer is this, but the projected usage-based revenue is only going to be that. So it's really misleading to do it across the entire customer base. You should do it by segment.
What about NRR and ramp-up revenue? Give us the overview, Ray.
Okay. Why don't you go ahead and just show the bullet points here. So we just showed you want to isolate the ramp-up revenue because that ramp-up revenue, based upon how you do it, may increase 5, 10, 20x from the beginning of the ramp-up period to the end. So number one, define and isolate your ramp-up revenue. Make sure it's consistently defined by the number of months. And one of the things you can do is use something called the net expansion rate to analyze the ramp-up revenue. So you can take a cohort of customers. I'm going to share this on the next slide, so why don't we just jump to it for net expansion, right? You take that cohort of customers, maybe it's by industry, region of the world, customer segment, company size, et cetera, and you compare the ARR or GAAP revenue of the customers for this most recent period. Let's say it's this fiscal year, and you compare that for the same customers for the previous 12 months, right? So this period, maybe it's current, the most recent 12 months versus the preceding 13 to 24 months. You now know your net expansion rate. It's a real nice complement to GRR, gross revenue retention, but do not factor in churn, because the GRR factors in churn, right? What we want to see here is for the customers who stay with us, what is that average net expansion rate? So hopefully that helped, Kirk.
Definitely, no doubt about it.
Now,
Something like a 2-year look back. This has been talked about a lot. We've got Snowflake listed here. I'd love if you could give that overview about that a little bit, about that story. I think those of us that don't know this story, this will be super interesting.
So, I still remember this was, 3 years ago. You read the 10 Qs or 10 Ks from Snowflake, and you saw 158, then 164, and almost 168% net revenue retention. And you're like, oh my God, this really is a snowflake on a unicorn, right? Because they were so incredible. But one of the things that they did, and this was about, I think it was 10 to 11 quarters ago, they were on an earnings call. And they said, we have a net revenue retention of 160%, right? Which is incredible. And it basically says, hey, my existing customers are growing 60% year over year. Then they said, about 20 minutes later, someone said, well, what's your guidance for your projected growth rate next quarter? And they said 55%. And an analyst said, wait, I don't understand. How can your existing customers be growing by 60%, but as a company, you're only growing 55%? That doesn't make sense, right? Are you paying new customers that other 5% to become new customers? And what we found was the way they were doing NRR was they took the customers at a current period in time and compared that to the revenue that set of customers was doing 12 months ago, excluding any churn customers. You cannot calculate NRR without including downsells and churn. So one of the things they came out with was their 2-year look-back methodology. And the 2-year look-back looked at, okay, let's take about the revenue over the last 12 months for a cohort of customers and compare that to the revenue from the previous 12-month period, so much 13 to 24 earlier for that same cohort. So the 2-year look-back still kind of eliminates the impact of churn, but they don't call it NRR. They just look at NRR using a 2-year look-back, right?
Sure.
So now,
see other companies adopting a similar approach?
Pardon me?
Do we see other companies adopting a similar approach now that the sort of the dilemma between growth and NRR was made public with Snowflake? Are other companies adopting sort of this 2-year look-back approach as well?
I've seen several companies use a 2-year look-back because it's almost another proxy for net expansion rate. I just want to see for the customers who stick with me, how fast are they growing? So the answer is yes, but as far as public companies actually using this on a standard basis, it's non-GAAP, and the answer is no. It's a minority, not a majority, Kirk.
Sure.
Now, I mentioned this earlier, and Kyle Poyer's a good professional friend, and OpenView from 2019 to 2023, early 23, they were the best organization regarding research for both usage-based pricing and product-led growth. So this is their framework. It's not mine, but I always like to learn from the best, and I think Kyle's one of the best in this. And it's just a framework for deciding on usage-based pricing, whether it's meant for you or not. And number one is, are your competitors doing it, right? Yes or no? And if they are, then you at least need to seriously consider it, right? Because that might be a competitive advantage. So do their customers like it? Now, what you're going to find often is customers love it at the beginning. So in my experience from the beginning of my career, we had customers like Dell and Sun and Ford and Toyota. And they are like, boy, we love this variable usage-based pricing because I didn't have to commit a lot up front. I didn't have to deal with a aggressive salesperson trying to get me to commit to a $100,000 contract, right? But then after 2 or 3 years, if their costs kept going up and they couldn't budget for it accurately, the CFO comes to them and says, you told me you were going to spend $100,000. We've got $323,000 of invoices from this vendor. What's going on here? I can't run a budget and a plan like that. So find out if your customers like it. If they do like it, right, you need to understand what your costs are tied to. If your costs are tied to usage, like AI companies, right? And native AI companies today, they have a lot of costs because they're paying ChatGPT or Anthropic or Huggy Bear, et cetera. So you might need to tie your pricing variable model to the cost infrastructure that you have, because AI is very CPU and resource intensive. On the other side, if customers don't like it, then you got to figure out, can you both reduce friction by providing usage-based pricing with low to no commitment upfront, or unlimited usage? So this is a really good, I know we're going to be sharing these slides, Kirk. This is just a good framework. But Software Pricing Partners has done pricing engagements for about 500 different enterprise software companies. And Chris Mealy, M-E-L-E, gives this advice. And this is from doing it 500 times. Do not introduce usage-based pricing to your subscription customer base as step one. Do it to a new customer segment. Maybe do it on a new product. If you're introducing a new product that lends itself towards usage basis, do it that way. But don't start with doing your beautiful Excel model. Well, if I converted all my existing customers from subscription to usage, we see a 12% growth inherently, right? And then you factor in some type of attrition, only 4% or 5%. That's a nice Excel model, but you're going to have a lot of your customer success and sales organization's time spent on dissatisfied customers. So start with a new product or a new customer segment.
What a great visual as a decision framework for UBP. Let's quickly take a look at this. This is a great framework that's kind of a 4-step model for setting up these metrics, right? It's pretty sensical in that obviously step one, you're going to want to accumulate the data needed for your metrics in one place. This comes from a variety of tools, right? ERP, billing system, invoicing. If you're doing something that involves more usage, like the product analytics tools are super important. But once you've got them together, stitching them together somehow is really important. And that's step two. What that essentially means is ensuring we've got an apples to apples comparison here between your data sources, where we're actually able to see how one item from one data set is affecting one item from another data set. Using those metric standard boards that Ray was talking about before, we'll be able to actually calculate those SaaS metrics. And if you ever want any resources on that, please visit Ray's materials. He's got great guidance on the SaaS metrics and the SaaS metrics board oversight. And then number 4 that really comes into this process once you've done 1 to 3 pretty frequently is the automation of this. Once you've gotten down how to create the SaaS metrics specifically for your company, you've defined your ramp, you've defined your cohorting analysis, right? How can we automate this process to make it a little bit easier? We can always arrive at the answer, but it's nice to arrive at the answer a little bit quicker. So here is actually an overview from one of the modules within Drivetrain. What you're seeing in here is a couple of the SaaS metrics listed here on the left. In that next column, the forecast formula column, this is where you'd write those formulas to define it. But amongst all of this, you're seeing some nuance to it, right? A lot of the times we don't want all of sales and marketing included, for example, in our metric. Maybe we just want the sales department. That's what you're seeing in the formula bar at the bottom there. Maybe it's not from this quarter. Maybe it's from last quarter. regardless of whatever the case may be, we want usually some nuance to it. So if I was to take a look at this, let me jump over to something like this here in Drivetrain. I'm going to go over to our metrics section where we can actually build those metrics. And if I was to take a look at something like CAC, which is one thing that we've brought up a couple of times today, Ray, I may want to do something like this. I'll name it, I'll categorize it to my SaaS metrics. But then when it comes to actually developing this, I have two options. One, maybe it's all in one data source, in which case I could go into those data sources and pull whatever I need in. But normally it's from multiple systems. The numerator might come from one system, the denominator from another. What I could do here is actually bring up the sales and marketing expense, which in this case is coming from NetSuite, and divide it by my new customers right here, which in this case is coming from Salesforce. Now, if I apply this, both of those will be put together across their time frame. Let's take a look at 2023, which is when this data is coming in. And I could see this coming into Drivetrain quite seamlessly. Now, the thing about this, and you've probably experienced this a lot, Ray, is that a lot of the time I get this feedback where they say, well, the sales and marketing expense from my current period is not what's feeding my new customers from my current period. It's not my sales and marketing expense from January that's feeding the new customers in January. It's actually the sales and marketing from a previous time period, in which case you should have the ability to set your time period, whether it's something like previous month, previous quarter, and maybe there's some nuance to your customers too. Perhaps it's not all new customers. Perhaps we're looking at a particular vertical here or particular region, some sort of dimensionality that we want to take a look at. And when I apply that through, I should be able to get to those answers pretty seamlessly as well. So here's a little bit about the metric setup. While I jump back to the slides, I'm interested, have you seen some sort of nuance or some sort of variability when it comes to metrics like CAC, to other maybe SaaS metrics that we've seen a lot?
Oh yeah, in the interest of time, I know we've only got about 13 minutes of this left, but I will answer it. Based upon your sales cycle length, your AC value, you may say, I want to take my marketing expenses for the previous quarter and my sales expense for the current quarter. And that's how I'm going to calculate my CAC ratio. So there's all kinds of nuances. So having the ability to be able to define those and then be consistent about those. And the biggest issue is where you get the source data from, huge value. But Kirk, if you don't mind, I want to get to the last thing, because this is where I have a lot of experience, a lot of pain. And usage-based pricing, a lot of times we focus on modeling it, reducing the friction. How does it impact growth rate? But as you scale, what your investors are going to ask, especially public investors, how do you forecast it accurately? So you think about how you forecast new business today. You know, the average company has a plus minus error rate of 11 to 15% on new business forecasting. So how in the hell are you going to be better at forecasting customers' actual usage and the associated revenue? So number one, you're going to have to develop the muscle capability and competency to project usage and the associated revenue. I learned this a long time ago, the concept of annual projected revenue. And we held both the sales organization, account management, and finance responsible for this. That for every customer and then cohort of customers, they had to forecast the usage for the upcoming 3 months, 1, 2, 3, 4 quarters. You got to do that bottoms up and top down. You got to assign responsibility. Who owns that forecasting? Is it the account manager? Is it a FP&A person that's assigned to a region or a country? You got to right now think about, how am I going to forecast the variability of usage-based revenue? Then you also got to think about, well, what about quotas? If I know that this industry is growing 30% next year, I just made the refinancing mortgages, right? Well, how do I set my plan for that, the financial services segment or the subsegment of mortgage brokers, et cetera? So that's where you got to consider all these granular variabilities, such as vertical industry trends, the customer's business climate, right? If I'm selling to OpenAI right now, a variable-based product, I'm pretty sure it's going to grow a hell of a lot faster than Salesforce, right? Seasonality. If I'm selling to retailers, I automatically know if I'm doing a value-based pricing, like percent of GMV, that we haven't even talked about yet, since usage-based pricing, it's value-based pricing. You got to know that, well, that's going to go up in the fourth quarter compared to the second and third quarter, right? If you're selling to retailers. And then you also got to do that forecasting based upon the stage of adoption and ramp. So if you're considering usage-based pricing, you've got to start thinking about the infrastructure and the ability to forecast down the road. So let's move on.
That's great. That's a great overview there, right? By far, it seems the most common way of doing that usage-based pricing is via cohort or something like this. And I'd be interested in your thoughts on this, right? Whenever we've done cohort modeling, whether it's in Excel or in Drivetrain, there's always two elements that I see that are necessary. One is this customer cohort number you see just under the dates in the top there, 10, 13, 60, so on and so forth. That is the assumption of your new cohorts that are coming in. For the most part, that is a best guess, usually based off of historicals. And you'll actually be able to see that where January on the x-axis meets January on the y-axis, I'll see that 10 again. I see the 13 repeating itself in the 60. That is those new cohort numbers. The behavior of those customers after that first month is defined by that retention curve. You'll see it starts at 100, goes to 90, 80, 50, so on and so forth. So that 10 from January becomes a 9. Obviously, that's the 10 multiplied by 90%. But then that retention curve resets for February. 100% of 13 is, of course, 13. But if we're rounding it, in March, that 90% is 12, right? And so on and so forth. So this sort of waterfalled cohort analysis is the best way I've seen to forecast it. High level, Ray, any thoughts on that, or any other ways that you've seen the cohort or the usage based pricing being forecast?
I think the only thing I'd really comment on this, and it can get complex and hard to use Excel to do, it's got to be I'm going to use segment differently. Often cohort reports to time and refers to time basis versus segment is customer type, like enterprise in US versus mid-market in Europe. You have to have the infrastructure and do the forecasting based upon at least one, if not two levels lower granularity by customer segment and by product type. That's the thing I would say. And that's going to get really complicated, Kirk.
It really does. One way we've tried to actually simplify it in Drivetrain is, typically when you're making these cohort models in Excel, there's multiple if statements, multiple index matches to create sort of this waterfall effect you see here. If I could jump back one more time to a similar screenshot, but this time live within Drivetrain here, those two items that I mentioned, the new cohorts and that retention curve, they're listed right here. One thing you'll notice is each of these new cohorts are the starting amounts for each of these line items. And then the behavior, the retention curve of those new cohorts is defined right here. So each of these items is growing and based on that retention curve as it pushes through. Therefore, if I was to change any one of these, just hard code them, right? I'll see that filter through to the appropriate cohort month. And then that now retention curve of, in this case, 101.5% on top of the 100% is what I'm seeing right here. The way we've simplified that is to make the expression like this. These two items being pushed together now is an if, index, matches, all these different complexities, which work once you get the hang of it, but are complex to update. Now it's a multiplication of two items. We're going to the new cohorts at time equals cohort. That just means that the January will always match up with January, February with February, so on and so forth. And then we're just going to take the retention curve at T minus cohort, essentially saying we're always restarting that retention curve with each new cohort. Again, the scenario-based planning can modify that. If you have a higher retention curve that you think might occur versus a lower retention curve that you want to sort of be conservative against, you're more than welcome to do that too. But it's a little bit more simplified than the traditional methods that we've done before. Let me jump back to this now, Ray, really quickly. We got one more poll here. If we could check the poll up on the screen, that would be super helpful. I'd be interested, Ray, any other high-level comments we've missed from the forecasting piece while people answer these polls that you want to comment on?
No, there's a few questions here, so I want to get to those as soon as we can, Kirk, because we only have about 7 minutes left.
Let's do it. So high level here, I'll just call out while we're taking a look at this poll, this directly relates to it. Here's a couple of our customers. We are the leader right now on G2 as the FP&A finance tool. So if you would like a demo, I'd be happy to give anybody here one. And then here's a variety of other metrics, other informational resources that we can have regarding SaaS metrics. If you want to take a look at this, like Ray mentioned, we'll be sending these out, so you'll have access to all of that. Let's jump on to the Q&A here. Anything that is jumping out for, I see a variety. We've got several different Q&A items right here. Ray, did you
I'm looking at
Yeah, go ahead.
a couple to jump out at me. The first one was, what would you consider committed usage? And some of the calculations. customer buys a million transactions up front, hey, that's committed revenue. That's a subscription. That's ARR. I would definitely factor that into bookings and ARR because it's a minimum commitment. And then someone says, we track the overage charge and a separate GL. Remember, I kind of said, okay, we should have subscription, which is committed revenue, and then variable usage revenue, exactly the way you should do it.
I see one here, Ray. This one intrigues me. Any suggestions on converting UBP into the standard renewal process? The goal is of turning non-recurring UBP revenue into ARR at renewal.
Different for every company, but the answer is yes. You should kind of say, okay, what is my thresholds, right? Say it's 10,000, 25,000, 50,000. You should proactively go to those customers and offer them a lower per unit cost for a minimum commitment. Your investors over time are going to love it. And it's going to eliminate some of those surprises where people come to you and say, hey, Ray, I budgeted 50,000. It was 60,000. Now it's 120,000. And my CFO says, we got to consider options. Because what we found when I did this a long time ago was the largest customers were the most likely to attrit. Why? Because they were spending more than they thought and they didn't feel comfortable talking to us about it. So have your account management AE team know what those thresholds are and proactively go and recommend lower per unit cost for commitment.
Beautiful. I got one from Jim here, simple one. How do you convert usage-based pricing into ARR 3-month average?
How do you do it? Well, once again, this is where you can define what your ramp period is. And if it's typically 3 months, you know that 90% of your customers will be 80% ramped or 100% ramped, then, right, you could say, okay, now I'm comfortable converting that to ARR. But once again, for me, I would rather just have that as my variable usage on GAAP revenue basis and not convert it to ARR until it's a firm commitment.
Okay, so it really comes down to that ramp. Here, I've got another one from Aaron. If you have a ramp-up period, what are the ways to get comfortable with the delayed ability to report new consumption from new accounts? For example, if ramp-up period is 6 months, it is tough to show traditional ARR bridge with new ARR, etc., since those logos are not yet mature.
So one of the things I've seen is you have a different ARR report for customers in ramp. Okay. And you can show and project that out over the next 1, 2, 3, 4 quarters, where they are and where you project them to be on a customer by customer basis. And then you can categorize that or cohort that. But you're going to start having to have a new report, which is your forecasted ARR for usage-based pricing customers.
Lovely. I got another one here from Ryan. We got 2 minutes left here, so maybe 2 more questions. Any suggestions on converting UBP into the standard renewal process? Goal of turning non-recurring UBP revenue into ARR renewal.
Yeah, I've seen one of the things you can do is have comp plans, and you can say for your account management team, we expect you to convert X% of your usage-based pricing customers to a minimum commitment of at least 80% of what they billed over the last year. I'm not going to give you the number because it can be different, but there should be a goal that's compensated for your renewal team on what that transition is to fixed contracts.
Lovely. Now let's end on this one. This is a very unique question from Chris. What are the top 2 reasons that people will delay testing a UBP approach, and are there valid reasons?
Yeah, number one is I've went out and I spoke, surveyed, talked to X number of customers, and the overall feedback has been very negative. I couldn't do a budget this way. I'm afraid my cost will go up. Only if you can guarantee me that I can have the flexibility if I use less, but my upside is not going to be as expensive. I won't go over budget. So talk to your customers, number one. And number 2, experiment. Right? When you do introduce usage-based pricing, don't do a big bang and don't do it to your current customers. Try to do it with a new customer cohort. And then the last thing for forecasting, because I saw a question here, you're going to have to be really good at looking at your trends over the last 1, 2, 4, 6, and 8 quarters to make the forecast by customer segment, by industry, by region of the world, et cetera.
Beautiful. Well, Ray, absolute pleasure. This has been intense, lots of good questions, incredible material. Thanks so much for joining us, and we look forward to having you back. Everyone, if you want to get in touch with us, you can do so using the emails or websites you see below. We'll send out this material and have it available for you guys, and be sure to follow up. If nothing else, have a great day. Thanks again, Ray.
Thanks, Kurt. It was a blast. Bye-bye now.